This couple, both age 58, have around $450,000 and would like to know how much they can spend when they soon retire. My name's Daniel, founder of McCluskey Financial. We currently serve a few dozen clients, and today we are first going to look at where they're at now, then what are they projecting to be able to spend, and finally, how can we tweak that potentially much higher? Let's get into it. So first, where are they at now? We're going to do a little breakdown of their net worth here. The situation is completely hypothetical. These are not real people. Pick the names here, Isaac and Felicia. So both of them, age 58. In this IRA here, this $380,000, that's what we're going to look at changes at later. But there's also the 401k that he's still contributing to. He's getting a match on that. $44,000 is sitting in the bank. And we're not going to include the value of their home in this scenario. We are going to include the expenses of the home and paying down the mortgage, but not the value they don't plan on selling. Next, we have their current and future income sources that are already happening regardless of what happens with the portfolio. So both of their Social Security, they're planning to take that at age 66. That actually gives them the highest probability of success given they want to retire at the ages they do, which we'll get into in the next slide. Currently, we have $72,000 in income for Isaac, $45,000 for Felicia, and Felicia has a pension that'll turn on at age 65 for $21.6 thousand. That will adjust for inflation, and that's also one of the main reasons that we wait to turn this on until 66. Next, we have their current savings strategy. All that's happening is he's contributing to his 401k, 8%, he's getting a 6% match. Of course, when they retire, he's no longer going to continue to contribute there. We are going to make some changes to that later, and then also we just have all of the additional RMDs going straight into a taxable account. Of course, this could be improved, but we're not going to look at it in this specific video. Now finally, their goals, these are their target retirement ages, as I mentioned earlier. 64 for Isaac, that also is a reason why they're pushing back Social Security till at least age 65. They do 66 for a reason. And then 61 for Felicia, that's when she would retire. Still wouldn't take Social Security though until age 66. So their goal for retirement is the $4,500 a month, and that is on top of the healthcare costs we have here. Long-term care costs 1 year for each room is all we factored in. Some people are not going to be comfortable with this and want to do much more. Just this example that we're going with just 1 year for both of them. That of course will adjust for inflation. And then also this will factor in, we have here the mortgage payment and all of those home expenses. This number is expected to be a little bit higher in today's dollars than the pre-retirement expenses we have here just at $4,000. So let's take a look if they just left everything the same at a simple baseline projection using a Monte Carlo simulation here. Now, just a caveat, this is not by any means any sort of guarantees. All they're doing is kind of looking at the past data and saying, hey, here is the probability of success that you have. But of course, we all know that none of this means that this is necessarily going to happen or even is accurate. For example, if hyperinflation occurs or the market soars down tomorrow, of course, this didn't look so reliable after all. So it's just a simulation. It doesn't mean that it's guaranteed by any manner. Now, with that in mind, to hit their $4,500 a month goal, we see here a probability of success of about 60%. That increases to about 90% if we reduced it down to $39.20 a month. And you can see in those red circles there, there's just less money coming from their actual investment accounts. So there's more yellow there in the top one in the $4,500 a month, and there's less coming in at the $39.20. Also, just to show you that again, that probability of success isn't necessarily something to die by, we have here a little bit of a stress test for the $39.20. So if the market dropped, if taxes increases, if Social Security was cut, etc., you can read all of those there. You can see the probability of success dropping. So we have the baseline here on the left at that 90%, and then getting lower and lower depending on what would happen. Of course, you combine some of these, well, then they would be lower. So we've went over where they're at now. We just looked at some basic projections. Now, how can we tweak that potentially much higher? Today, we're going to look at a strategy called a strategic rollout. Now, first, what is that? And then we'll look at why someone might actually ever consider doing this, and we'll show all the numbers here shortly. Now, a strategic rollout is when money is strategically rolled out of a pre-tax account, so like a 401k or an IRA, then taxes are paid, and finally, the money is rolled into a post-tax dollar account, grows tax-free, and the idea is you eventually are going to take income from that tax-free, so you're kind of getting the taxes over and done with. Strategically rolling it out Also, just means you're taking your tax brackets into account. If something is going to kick you into a much higher tax bracket, you might not consider pulling out much more if you might be able to squeeze that into the same tax bracket next year, similar to how a Roth conversion works, but it's much different. I just want to point that out. Now, after the policy is funded, which is generally around 5 years, that can vary between 3 to 7 years, usually for most people, at some point, tax-free income is taken via those policy loans. So you are using what is called an index universal life insurance policy, and you're maximum funding that. So to access that money tax-free, you actually have to use policy loans if you are withdrawing anything above what you put in. So if you put in $300,000 into a policy, you could withdraw all of that tax-free. Any gains would be taxable. That's because the money is growing tax deferred. But you can never actually realize that deferral status if you just want to access via policy loans. Then the money is completely tax-free. And those loans are later going to be paid off by the death benefit, which essentially means, without getting into too much detail, your death benefit always is going to stay a little bit ahead of your policy loan balance. So if you have a loan balance of $500,000 and you pass away and your death benefit was $600,000, it's going to pay off that $500,000 loan, and then the remaining $100,000 would transfer to your heirs income tax-free. So since it transfers tax-free after paying off the loan, that's how you never had to actually realize that deferral status. So you can see here in this little picture on the right, there's much more money being pulled out at age 60, 61, and 62. This also would happen at 58 and 59. It's just not showing on this specific chart, even though they only needed $4,500 a month on top of some other additional expenses. Why would it be so high? That's because they're doing that strategic rollout. They're getting money out early and rolling it into a maximum funded, properly structured indexed universal life insurance policy. And we talked about the tax benefits, but why still would someone actually do this strategy? So first, not just that it's tax-free, but you also are opting out of tax rate volatility. So same reason someone might do a Roth IRA, because they say, I'd rather just pay the taxes now and not deal with, for example, politicians raising taxes in the future. And even though I'm in a lower tax bracket, since they raise taxes, they're higher. I'd rather opt out of that. If that's a concern, sometimes people will consider this strategy. It also can be safer than the market in the sense that cash value is not lost due to market downturns. So if you're using an indexing strategy, typically it is like, this is not actually what's happening, but it's like you're investing in the S&P 500 with a floor of, say, 0% and a cap of, say, 10%. So that means if the S&P 500 goes above 10%, say 20, you're only going to get 10. If it goes below the floor, say minus 10, minus 20, minus 40, you're going to get 0. It hits your floor. If it's in between those two, 0 and 10, then you'll match what the S&P 500 does. That is what's called indexing, and that's where it gets the name Indexed Universal Life. Again, of course, there's no guarantees with this, but that would be why you want to go with a highly rated insurance company and one that has a track record of treating policyholders well. Hopefully this isn't too big of a concern for you. We won't go into it in this video, but if you'd like to learn more, look at the history of insurance companies during the Great Depression, during 2008, etc. It'll probably ease some of your tension. And two other things: money is always liquid without penalty or taxes if accessed via a policy loan. So if you're accessing that, you're not going to pay some sort of pre-59.5 penalty like you might if the money was in a 401k or an IRA. Also, you can use that indexing strategy to get pretty reliable returns. Of course, it's not guaranteed, but the idea is more so hitting singles rather than trying to hit home runs in the stock market. And as a trade-off for that, we have some protection due to market losses. It's worth noting, however, there are strategies where you can potentially get much higher returns. We're not going to talk about those today. Before we show the difference, a couple disclaimers here and warnings I want to give. IUL is not considered an investment, and I would say this is actually a good thing. If it was considered an investment, we would get the tax treatment of an investment. It is an insurance product, it is a contract. The idea is you're putting money in, you are overfunding a life insurance policy, wanting the most to go towards the cash value, the least possible, as defined by the IRS, to go towards the death benefit, and you're going to let the cash value grow, reap the tax benefits, and since you put that little bit towards insurance that complies with the IRS, it's considered insurance, not an investment. Also, incorrect policy structure, so I mentioned most of it going towards the cash value. So if half of it's going towards the cash value and half towards the death benefit, well, then you're going to have a way higher death benefit. It's going to be way better for you if you pass away early, but that's typically not why people are doing this. And if you're doing this the way that we're going to go over today, because it will give you much more death benefit, the internal rate of return is going to be much, much worse. In fact, this could really harm someone's retirement if it was not structured properly. Not only do you get less income, but also the agent is going to get much more money, so be wary of this. Over 90% of IULs are not structured to be used in this manner. So it's not just getting the product, it's about getting the product with the right structure and the right strategy. If you're seriously interested in this strategy, do consider farther study and make sure you use an expert, not just your nephew that sells life insurance. Finally, with that, let's look at some examples. So the year one funding here, this $60,000, is coming from savings that he already has in his bank account and additional savings that he's making from his income. So no pre-59.5 penalty is applicable here. So we have $60,000. This is a real insurance company illustration going in the first 5 years. You can see the accumulated value after 6 years, right before he starts to take the income, is $297,000. Again, that is post-tax though. The other $300,000 before was pre-tax. So we're rolling out $300,000 from the IRA and into the IUL. Keep in mind though, there was more, there was $380,000. Maybe we could assume that that money was going to grow. We could have done more, but we wanted to play it a little bit on the safer side just by using the $300,000. And now from that number, that's the number we're going to use generally to take about 6 to 8% of that money into perpetuity, tax-free, not adjusting for inflation, for the rest of your life. You can see here, this illustration projects $25.1 thousand, all of that completely income tax-free. You're not paying any taxes on this. This gets paid off by the death benefit when you pass away. Now, even though this illustration is from an actual life insurance company, they're illustrating at 6.33% before any fees, and the income rate, so the percentage of this $297,000, is 8.44%. For me personally, that's a little aggressive. We're going to look at a second one where it's a little bit lower. The loan rates, though, I can't say it's a specific percentage, and that's because while you do have the opportunity to earn what is called an arbitrage, or say you're loaning money at 5%, but the policy is performing at 7%, so you're actually gaining 2% on money you've already taken out and spent because of a recent regulation, which is a good thing in the life insurance industry titled AG 49, you are not allowed to illustrate more than a 0.5% arbitrage. So even though we might be loaning at, say, 5%, if the policy is performing at 6.33%, they don't illustrate the accumulated value actually performing at that. They drop it down to 5.5, so it keeps that 0.5% gap. Just a caveat there I wanted to throw in. But they have here, this is a real life insurance company illustrating at $25.1 thousand. Next, we have, this is not a real insurance company. This is a software that was built by the best in the industry when it comes to Index Universal Life that I use. It doesn't represent any actual insurance company. It's just intended to be used for educational use only. So they funded the policy a little bit slower, $58,000 the first 5 years, $10,000 in the 6th year, and then they projected with a loan rate of 5.5%, income rate is 6% of this number here, $21,000. They're illustrating at 6.45%, a little above that before fees, but they're taking much less money. This is going to be much more on the safer side as opposed to that $25,000 we saw before. Of course, it could get up that high if the policy is performing well, but today we're just going to illustrate it a little on the conservative side. Still not guaranteed, of course, that that happens, just a disclaimer. And lastly, this is what we actually inputted into the retirement software before I show you how it changed the probability of success in the income. We did the $60,000 in 5 years. If I lowered this to $55,000 and then put a little over $20,000 into the 6th year, it also increased the probability of success by quite a bit. If I went a little bit higher than $21,000, say $23,000, it also increased it even more. I really wanted to keep things on the conservative side here. So $60,000, 5 years, $21,000, just about 6%, so we can show you a fair comparison. Again though, none of this is guaranteed, and again, same thing here, this does not represent any actual insurance company, just for educational use only. However, when we do that, with all of those caveats I just gave, it unfortunately lowers, for the $4,500 a month, the 60% probability of success with no IUL all the way down to 55%. But, hey, and real quick, if this is helpful, leave a like and let me know. It helps me out. Back to it. From 2033 to 2041, if we had that $21,000 coming in tax-free income on top of the Social Security and the pension, we're actually receiving much more income than we need. And the software had it to where that additional money is just being spent. Here's an example. In 2034, this was the highest of the income. As I said there, it ranges from 1,400 to 10.1K. We have all of that money just being spent in 2034. So what I did is, instead of just having that additional money being spent, which was not there before we included the IUL, I added, what if you took that additional money and contributed to a taxable account and then kept the same assumptions that the software generally has? In a real case, we probably just wouldn't actually pull this money from the IUL, and we just let it continue growing, take out less in loans this year, maybe take out more in future years, and that would have even probably a higher probability of success than this, what we're using here. But for example's sake, we're just assuming it goes into a taxable account at the default presumptions. If that's the case, in 2033, we have $2,000, and then you can see here throughout, depending on which year it is, a different amount going back into a taxable account that could later be taken out. When we do that, that takes us from the 60% without the IUL all the way up to a 72% probability of success. You can see here in this circle, the green there, that is the money that's coming from the IUL. And of course, that is all coming out completely tax-free. Now, that is with the $4,500 a month that it got it from the 60 all the way up to the 72%. With the $3,920 a month, it gets us from the 91%. And this is because the reason it's 91 and not 90 is because I kept in that additional savings there that there actually was there to re-put in when we lowered it down to the 3,920 instead of the 4,500, all the way up to 96%. And since we lowered it down to 3,920, you can imagine there's even much more money in all of these years that isn't getting reinvested into the taxable account that we made the assumption before might even get this up to 100%. If we did that, we didn't in this example. That, again, you can see the green there, that's the money coming from the IUL. That's coming completely income tax free. Of course, final warning, this has to be structured correctly. It has to be treated with care. If you really are interested in learning more about this strategy, I'll include a link in the description to a video below where I go into much greater detail. So how much can you spend in retirement? Can this couple, this hypothetical couple, spend? Of course, it's so tough to give an exact number. There's so many things that could be factored in, like the retirement spending smile might even get that 72% up into the 90s if we factor this in, which is basically that people don't tend to spend the same amount throughout retirement, but it actually goes down and then comes back up relative to inflation. If we factor that in, it could be much higher. If they're not disciplined and committed to this plan and being flexible, if things happen in the market, if some sort of hyperinflation happens and they have no gold or Bitcoin or some sort of hedge, so many things can make this number different. So it's just for example's sake, it's just high level. I tried to keep it very digestible, even though it was so much. This video was a total pain to make. If you enjoyed it, if you're within 10 years of retirement in the US, subscribe. I release videos twice a week for you on how to do that peacefully.